Welcome to Your Money, Your Call, Bonds versus Equities. I'm Mark Todd from the NAB and I'm joined by Roger Montgomery from the Montgomery Fund and a real-life politician, Kevin Hogan. He's from the seat of Page. Now, feel free to ring in and talk about whatever you like, but Kevin is one of many things. He is a friend of mine, that's number one, so be nice. Number two, he's an ex-banker. And number three, what's the third thing that'd be good about you? Oh, you're a nice bloke, you know, you just sort of... You talked to the Governor Stevens today.
Yeah, I did.
And so that's the reason why we've got Kevin on, because he can actually give us some live appreciations of the performance of the Governor. So feel free to call us, 1300 30 34 35. The email is yourmoney@skynews.com.au. Welcome. Great to have you both on.
Nice to be here. Thanks, Mark.
Let's start with you, Roger. I just want to... You were talking about the fund, the performance, everything that's been going on. What's been happening with your fund to date?
Well, for the year to January, the end of January, we've achieved about a 3% outperformance over the index, but that's been done with about 30% in the safety of cash.
Yep.
And it has been very, very tough.
Yep.
And the reason why it's been tough is because we've had a lot of the rubbish going up. So companies that we would never own, their share price rises, and inevitably, when you've got a very narrow universe of companies in the Australian market, the oil price drops, people jump on Qantas.
Yep.
But it's not a business that in the long run makes a lot of money. And in fact, its market capitalisation is still less than all the capital that it's raised from its owners over the last decade. So we see lots of businesses like that. BHP is another one that rallied strongly today. Its profit in 2014-15 is not forecast to be any higher than it was in 2006.
Yep.
Yet it's got 3 times as much debt. So the banks have given it more money. Normally, if I give you more money and you put it in the bank, you're going to earn more.
Yep.
That's better than what BHP has done.
Right.
You know, and they've got more equity, more debt, and less profit.
You're negative on the BHP story. You're negative in the commodity world, aren't you?
Yeah, we think but these things still go up in price. So the question is, do we buy good businesses and fill our clients' portfolios with outstanding, extraordinary businesses that over the long run are going to do exceptionally well for them, or do we buy the things that are going up? And our view is to ignore the things that are going up and buy really good businesses. But it means on a day like today, we're going to underperform. Because
if you've overperformed by 3%, that would suggest that the things that you liked have rallied harder already, so it's harder to find.
Yeah, that's right.
It's harder to find, though.
We can't find a lot of value in the market. There's 3 or 4, and later on I'll tell you what they are. 3 or 4 companies that are still cheap.
Oh, beauty. We'll all hold on for that way. He is Liberal, what are you, National Party? He's not the Liberal Party.
So every year for many years I went to the National Prayer Breakfast. I was invited down. It's a closed door, no media. And you can't help but leave that with a very strong sense that politicians are genuinely trying to do the right thing for the country and for their electorate. The problem that you've got, of course, is that the media, the 24-hour news cycle, you can't help but be distracted from doing your job to feed this machine, this ferocious machine that constantly hits on every single comment that's made. And I think 100 years ago, an Australian politician had a much easier time of getting on with the job, because every month or every week they could report back to the world and say what was going on. But now there's somebody with a camera in your face every minute of the day, every time you open your mouth, and it's a distraction.
It's the most important issue for you.
I think that's right, and I think there's a short-term fix, but there's a better, more sustainable long-term fix. We have a current account deficit, which means we're spending more on our imports than what we receive for our exports. Yep. And successive governments in Australia have never really done anything to address that. And Andrew Robb said to me at breakfast a year and a half ago, he said, it's structural, Rog, we can't do anything about that. Well, in reality, we can. The problem is we don't add any value to our exports. It takes about 7 tonnes of iron ore exported to buy 1 iPhone. And the problem that we've got is that we have to, if we've got a deficit, we have to attract foreign capital to pay the difference. Mm-hmm. So the way we do that is we either borrow money, and the Liberal National Party are ideologically opposed to that.
Which we'll talk about later.
The alternative is to sell assets. So we sell our farms. You know, 14% of arable land in Victoria is now owned by foreign owners, mm-hmm. largely Asian. And so we're selling a lot of our farms, we're selling a lot of our businesses, and I think there's a better solution. And what we need to do is, and I mentioned this outside of the studio, what we need to do is we need to come up with a tax structure that incentivises the market to identify what we're good at and build new businesses to replace the ones that are old and not competitive anymore. But we need that tax structure to be changed. And one solution is to have a tax holiday for start-up businesses. And I don't mean Woolworths Neutral Bay Proprietary Limited. I mean a real start-up business. You know, and then the market will be very good at identifying where to allocate capital, and then the government can come over the top and support something that's going very well.
Chris Joy...
That creates jobs.
Chris Joy, who's a friend of ours, writes that...
I had lunch with him today.
He thinks... Where's my invite?
Oh, sorry, mate. We were talking about you, not to you.
Goodness me. No, I don't have lunches because I have this show. He was talking about the fact that the pricing on the RBA, the pricing on cash, is creating a misallocation in money.
No doubt.
And what it means...
risk.
That's right. And what it means is that we become unproductive. And therefore... Yeah. To your point about, OK, let's give them the incentive, Chris would say, well, OK, are we making those organisations unproductive? Is the market forced to say, OK, they don't pay tax, so therefore we will price them differently. We'll lend them money at a different space, different rate because they don't pay tax. So I don't disagree with what you're saying, but
there are businesses that can't borrow money. The banks won't lend them money. And they won't lend them at the low rates that you're talking about on an aggregate level. They have to borrow money at 18%, you know, and that's not productive.
But even the shadow economy was saying, OK, 10% is a really good number, so I'll charge 10% for this startup. So that's what he's talking about, that filtration of...
It doesn't happen. It's nice on paper, but it doesn't happen in the real world.
How are you, mate? Look, just reading the Fin Review today, Switzerland issuing tens of millions of dollars of bonds at 0.011%.
Yep.
What's that mean for the world? And why Australia, with its AAA rating, why can't we do a similar thing? And to Kevin, mate, I mean, how are we blessed with Lambie and that Ricky Muir, mate? I mean, we've got to get rid of them. And to Roger, mate, look, I'm a Burson shareholder, Burson Group. I just noticed in the Fin Review today, with Repco along, they are raising prices by about 5 to 7%. Mate, that is inflation. But the major thing you were talking about there, mate, all of it's imported. All the manufactured stuff they bring in is not made here. Thanks, fellas.
Thanks, Richard. Steph, there's a chart I showed you on Switzerland. Do you reckon you could bring that up for me? Just to Richard's conversation. So what's happened is, Richard, you are dead right. And so here's the theme. When I'm going to try and bring in a chart of the week, and this is from Peter Jollier, head of research, and we were talking about this. So what happens when rates are below zero? When you normally put the money in the bank and return deposit, you get a rate.
Why would people buy a bond?
Why would you buy any asset? Why would you buy any asset?
Paying the government to hold their money.
So what you do is you try and look and see what your monetary, this is what the governor will be doing. He has interest rate settings and he tries to look and see what happens, what's the cause and effect. If I put rates down here, what happens? So Richard, let me show you what happens. This is the 1,000 franc, Swiss 1,000 franc notes in circulation. And so as they started to cut those rates, just have a look at it from 2009 and then look at it into 2014. These are 1,000 franc notes. It is easier. This is literally put it under the bed stuff. People are taking these notes out of circulation and putting them in a safety deposit box, sticking it under their bed, doing something, whatever. But what you're seeing is the impact of negative interest rates. People take the $100,
and
take
why
the 1,000
are people
francs.
interested in doing that? It's because they believe that the story is a deflation story.
That's right.
They believe that, unlike inflation, where $1 today is worth more than $1 in 10 years' time, it's the reverse. $1 in 10 years' time is worth more than $1 today.
Yep.
So you're better off putting the money under the bed in cash or buying bonds because you've got that regular stream of income, which is worth more in a deflationary world. You defer your purchases because things are getting cheaper and you put the money under the bed.
Correct. The chase for yield is literally about to kick off. It hasn't even really started. It's about to hit steroids because of those numbers I just showed you.
There's three forces that have been driving this, and we talked about this in the middle of last year.
Yep.
And I think I entitled I wrote a blog post on this, the bubble we have to have.
Yep.
So you've got this massive demographic of people in what I call the panic accumulation phase. So these are the baby boomers about to retire, and a bunch of them are starting to now, but they're about to retire. They believe life ends at 65, so they invest for 65. They don't invest for 95, which is how long they could potentially live.
That's the challenge, isn't it? Right, that's right.
They invest for 65. So they're panicking about getting the income up for when they retire. At the same time that boom is happening in the number of people who need income, interest rates on term deposits are very, very low. It was the case that years ago, if you saved $1 million, if I'd said to you when you were a kid, you're going to have $1 million when you retire, you'd be going, woohoo. You know, now you put $1 million in the bank, you earn $27,000 in interest. And I think the poverty line for a couple with 2 children is $39,000.
Yep.
So you're earning less than the poverty line. So by definition, if you've got $1 million in the bank, you're impoverished.
Yep.
Right? And so
try and spin that.
Yeah, so they're forced to invest in other things. They're going up the risk profile, so they're investing in equities, they're investing in property at high prices.
Yeah.
And they've got a disproportionately large amount in cash because they all pulled out of the stock market in the GFC and put it all in the bank.
Or they
so
got
those
stopped
three
in their
things
margin
now is
lending.
moving the other way and pushing people into the stock market, driving prices up, driving property prices up. But the one rule of investing that you must never ever forget, and that is the higher the price you pay, the lower your return.
Sound to you?
I'd like to see a lot more than that, you know. And with the greatest of respect to Kevin, I'd love to see Singapore, for example, is so successful now. How have they managed to do that? They've said to me that if I start a funds management business in Singapore, if we're going to start a global fund at some point, if we base it in Singapore, the first 3 years, $200,000 profit, so the first $200,000 profit for 3 years is tax-free. The next $100,000 we will end up with a discount rate, 50% discount, so 7.5% on 100 grand. So I can earn $300,000 profit and only pay 7.5% on the last 100,000 for the first 3 years. Why wouldn't I? And plus I get other incentives because I'm a financial services business. Why wouldn't I start my business over in Singapore?
It's really hard to compete. Singapore is such a small place and we're such a bigger place, and it's just so hard to go apples to apples.
Think about it as a business owner, as an entrepreneur, the government, and correct me where I'm thinking, my thinking is in error.
Well, I agree with you.
The government's not getting that revenue anyway because I haven't started that business. So give me a break. Let me start the business. I'll employ people that have lost their jobs at Ford and Holden because that was uncompetitive, and so I can do that.
We're going to just before the break, we were talking about the dynamics between Singapore and Australia, and I was making the point in the ad break that there is a difference in philosophical view. In Singapore, the legislation is around supporting the investor, the entrepreneur. And buyer beware, bad luck, you look after yourself. You need to be at a position where you can go on...
Mind you, if you do the wrong thing, you're shot.
Yeah, that's absolutely. That's spit. If you spit or chew gum. Whereas we, as a country, are trying to de-risk everything, and that means not just. It's more about de-risking. Think of it in terms of the banks. The banks are too big to fail. You don't want them to fail, and it's all that emphasis. And you hear the banks complaining about this is bad for business, all these regulations. Those regulations are not going away. And that's a global phenomenon. It's not just Australia, it's everywhere. So that's the difference, whereas Singapore aren't limited by that. They don't have that.
I've got a problem with so much more than that. Let's take an Aussie farmer.
As an example.
Yeah, let's take an Aussie farmer.
Yep.
On the one hand, he's being squeezed by foreign imports that are cheaper. On the other side, he's being squeezed, and the cost of inputs. And the cost of inputs, Monsanto, for example, charges whatever they want. They're a monopoly. Right? And then on the other side, he's got Coles and Woolies, you know, screwing him on the supply, you know, and that's being repaired slowly, thankfully, and it will be slow, but it will be fixed. Aldi will fix it for everyone, I'm sure, if they don't. But then the farmer is forced to say, well, I can't make any money. And then someone from China comes along and says, I'll buy a farm for $50 million.
I'll take the food.
We've lost it.
Yep, I'll take the food back.
And then what happens is there's a free trade agreement negotiated with China, you know, and Andrew Robb says, the Chinese business, that farm, now owned by the Chinese, they want to have their workers on the farm. So now they'll build a little village around, and under the legislation they can pay $16 an hour or $17 an hour, and we're going to preserve the Australian labour rates, but they can also charge whatever they like for board and food. And so they pay these guys $2 an hour, but provide board and food. I've got a real worry that we're now out of the loop on our own land. We're serfs on our own land.
Look,
I don't want to be overly negative. Everyone's got their own. I can't offer individual advice, but I would describe ANZ as long and lean.
The way to...
And if I want a security, I want short and fat.
Would you do it with your money? No, neither would I.
I prefer short and fat on my securities, not long and lean, and more like me. And one of the things is that I've spoken about this point of non-viability, and that's where Chris Joy goes on about it, and he goes on about the dividends being stopped.
The probability of a bank going up, blowing up in Australia is very, very low.
Yeah.
So yes, it's true that these notes rank just above the equity in the event of a liquidation, but I think for the purposes of the next 8 years, you don't need to worry about that. The question is whether or not there's a better yield for the risk that you're taking. And these notes tend to trade, particularly in the early days, they tend to trade a lot like the equity. The volatility isn't pronounced, but in a GFC type event, we saw that they traded like equity. But you're not getting an equity-like return for the risk that you're taking.
Correct. You're not going to get the same sort of return in equity, but then again, you're not going to have the same sort of volatility. You won't. But the point that Roger's making is it's about probability, and that's the important thing. On this point of non-viability, I treat it as a probability question. So what is my interest rate? What is my duration? So probability is around how long am I exposed to the chance of this happening? Is it a 2-year instrument? Is it an 8-year instrument? So then you start factoring in, is it longer term instrument? What's the probability? So if you get 5-year probability, 8, 7, whatever it is, multiply by your interest rate.
We saw it with the pearls.
And multiply by your volatility.
We saw it with the last pearls. The pearls, were they 7s?
7s.
Pearl 7s. So they were offering 3 points.
No, they were 2.8. So that's
2.8.
That's the probability story.
Right. But people lost 4%.
No, that's my point. That's my point about probability. It's not the loss because they're not selling.
Somebody sold. It wouldn't price there.
The uninformed. So, because what happens is, it's 2.8 was the wrong rate for the probability.
Yeah.
That's what I'm trying to say. So if
you're saying, but you don't think even 3 point.
So I'm saying 3.8 for that 8 years. But the thing is, my cash flow, it's every 6 months, and so it's a longer term. And I just don't feel that that's the best option. We showed viewers,
and I'm not prepared to do this, but given the choice between buying the ANZ equity. And we own ANZ shares, but we wouldn't buy them at this price. We bought them earlier. Given the choice of ANZ equity or this particular security, I'd rather buy the equity. I met a couple earlier this week for breakfast in Linfield.
Yep.
And
lovely suburb.
They sold an apartment on the Northern Beaches. They've downsized. They're left with about $800,000. That's their retirement nest egg. How do they survive on $800,000? They're in their early 70s. That's it. That's all they've got.
Yeah.
And the income on that, on a term deposit, you're talking $20,000.
After you take inflation out, even inflation is going to be at 2. If you get the currency down to 70s, inflation is definitely at 2 because we import that inflation.
It's a huge problem for a very large cohort of the population.
And my point is, in your retirement, you have to get engaged.
But I'm telling you why I'm worried for them, because they're being pushed into these higher risk categories in order to achieve the yield, and one day inflation will come back, and one day interest rates will go up, and we know what happens when interest rates go up. Their capital's going to be wiped out. What we've got is these public-private partnerships, and unfortunately you do a deal with Transurban and they add an extra lane only when the demand is there, and meanwhile everyone's stuck in the traffic and we're not being productive. So if the government, instead of a public-private partnership, if the government said, do you know what, we're going to buy a productive asset, we're going to charge a toll, we're going to make the return, and you're borrowing money, you're going to get a better return from that asset as inflation raises the price of the tolls on the road, instead of a public-private partnership which closes off a lane in order to have 2 lanes that they make the profit out of.